You just you just pick up a lot of influence from whether it be members of your family or I could probably talk about my parents or something like that. But then there are also other kind of influences from the industry. I think obviously all entrepreneurs is like very kind of inspiring to me. But the thing that really got me interested in venture capital is when I was like younger, I was always interested in, when you're a kid, you're always interested in sports, right? That's my favorite athlete. Oh, that's my favorite player. And then later on, you're interested in like, in my case, music. I'm a kid of the 80s. We had MTV. I like Prince. I like Michael Jackson. That's my favorite, you know, thing. And so I guess you could say my investing begins there because I would invest in, something that I enjoyed. I would get all the albums of my favorite band and go see them in concert. That's an investment. We own, or that is something that we own. When I got into the business world, you hit your 20s, you're less really into sports and you're more into like making money. I want to become awesome, you know. And so I would read all the Wall Street journals and I would read all the Forbes magazines. This is again back in the 1990s. I'm really dating myself when I'm talking about getting magazines. But if I was getting on like a train, obviously you go like on a train and you get a magazine to read on the train. So then I would always be reading the biographies of somebody that was important. Behind all of those great biographies, they would talk about, let's say, how Apple got founded. And they always tell this like ridiculous story. Like, oh, they were just a couple of guys in a garage putting computers together. I was like, oh, that sounds really easy. And then you go, and one day they just happened to meet a venture capitalist who gave them $100,000. And now that venture capitalist's money is worth $1 billion because they gave $100,000. And I was like, boy, that sounds awesome. All I have to do is give $100,000 to somebody and I'm going to get $1 billion back. What is this venture capitalist? What is this? And then in the 90s, I don't know what happened, but like there was all this like PR on venture capital, Silicon Valley, venture capital, the dot-com bubble. Oh, all these VCs are great. I read a book one time, I remember. It's called The E-Boys back in like 1998. And it was about benchmark capital. And they were like 6 good-looking, athletic guys that had started benchmark capital and they had invested in all of the household names of the dot-com bubble, eBay, blah blah blah. And they would write a story like, oh, we just invested $100,000 in eBay because we met that guy in a diner and we just threw the money at them. And then it IPO'd and suddenly our $100,000 is worth $10 bazillion. So I heard those stories like, well, that's for me. I have to do that because I'm really lazy and I don't have any good ideas. So all I have to do is get I have to find money and I have to put that into some guy at a diner and then I'll be worth $1 billion. That's what my like little 25-year-old brain was. But of course, who knows what venture capital is? Along the way, I did some entrepreneurial things. And I got to business school. I had an opportunity to get an internship, and that internship was venture capital, Tokyo, Japan. And I said, that literally has my name on it. I love Japan. I took a little bit of language in Japan. It was perfect for me. So I sat at a desk for 3 months in Tokyo, and I was just looking at business plans. And my first day, I sat on a due diligence call with the largest VC firm in the whole entire world. Kleiner Perkins, my first day on the job, and I just said, I am a VC right now. I'm asking them questions. I'm getting paid. I, I'm home. No, it wasn't that. That wasn't the end of the story. The internship ended. I finished business school. I couldn't get a job. I had to kind of go at it, and then I had to become an angel investor down the road, and then that was a while. And then 4 years ago, I started Tacoma Venture Fund and raised money from area investors. So, long journey to where I am today. But at the end of the day, venture capital is definitely like my calling. It's something that I am deeply, deeply, deeply passionate about. I would do it for free. I'm not going to, but it's just something that it's like I can't not do it. And so that's why, I'm deeply engaged with it. I'm deeply passionate about it. I love what I do. And, and I'm an entrepreneur. I'm building out TVF. So, I can empathize with the founder's journey because, I have sleepless nights and don't know where I'm going to be in a couple of years. And I don't know how I'm going to get to where I want to go. So, it's a very similar kind of experience that I go through.
Fantastic. Thank you very much for that very detailed, explanation there of your journey so far and what it's been like. I think, there are quite a lot of, funny bits. And sometimes I think part of the problem is how the media makes it. Like you say, when you read those books and in some of them, or the articles that you read about starting a business, and you see that they started in a garage and they've raised 100K, and they don't really provide the details. And I think sometimes it sort of misconstrues the whole process. It makes it look easier than it actually is in real life, when it's not as easy as they make it seem in books and in the medias most of the time. So it's quite interesting that you sort of gone through that journey and you've sort of made up your mind, sort of hanging on what you've said there. I cannot do it. It's something that you're quite passionate about. Now, if we go to TVF, and you said, so it's been 4 years, and of course it will be an entrepreneurial journey. It's just that it's it's more like a financial business. So that's a whole different experience on its own. But if we start thinking about TVF, and when you say you still have those challenges, the problems, like any other founder, that keeps you up at night, the uncertainty of what's it going to be like in 2-3 years' time, especially as economic indicators are not very encouraging at the moment, very high levels of inflation, people are there's a recession looming and all these other factors hanging around. This is not the time a lot of people would want to take risk. So with that in mind now, it's moving on to my next question about what are, as you stay on the path of being a business angel now, because I teach entrepreneurship, and obviously when you teach entrepreneurship at both undergraduate and postgraduate level, one of the key things that you'd have to talk about is the finance. And of course, when we talk about business angels, we'd say, business angels are high net worth individuals that would invest in startups, and they will invest a certain amount of money. Now, when we say that high net worth in, individuals, people might begin to say, oh, these are very wealthy people that have money to throw around loosely. Do you just want to give us a more expert definition of what a business angel is, in a much more practical way? I think that'll be helpful.
Well, an angel investor I'm not an angel investor, I'm a venture capitalist. I used to be an angel investor. An angel investor is an individual with net worth over $1 million, or they have something like 2 or 3 consecutive years of making over $200,000 per year. and that could be you and your spouse combined. So it's a broad definition. There is also a technical element called a qualified investor, which would be someone that has over a net worth of $5 million. And that is like a higher hurdle. Not everybody is a qualified investor. An angel investor, and they're everywhere in the world. I think that what we are looking for when we're thinking about a high net worth individual is, who are people in our local area that we can contact, that we can connect with, and that would be interested in the entrepreneurial journey. There could be someone related to your field. Say it could be like medical. Maybe you want to talk to a doctor who is experienced in their field. Or it could be in real estate, and you would want to talk to successful real estate developers. I think that there are a lot of ways to find them. One practical way to find them in the United States and in other areas of the world is through the Angel Capital Association. And that is a database of angel groups. Now, where we live in Tacoma, Washington, there is no angel group. So you would have to be thinking, if you want to go local, is talk to angel investor groups in the Seattle area or in Spokane. There are other networks like investment clubs, and those could be like local area business owners that all know each other. They may go to dinner together or play poker together or play in the same golf tournaments. And so you would try to find a way to network in that. But to bring that all to a close is, I always advise entrepreneurs or founders or people interested in startups to get involved with the local community of entrepreneurs. Go to events, go to meetups, attend functions, attend speeches, attend some of these things. Take the time to, a lot of them happen at night, so you could work a full-time job, and then you could, go to an event. Sometimes there are all different types of events. But there used to be one in Seattle called Founders Live, and it was at a bar, and you would go to it and you would hear like something like 90-second pitches for a company. And a lot of people interested in the scene would just go to it. And I don't want to go too long on this point, but the analogy I like to give is, if you were a musician and you wanted to become a professional musician and get paid for it, where would you go? The answer is, you would go to where other musicians hang out, and you would just, you would go to maybe Los Angeles or Nashville, Tennessee, and you bring your guitar and you go to a bar where there's live music, and you just ask around, does anybody know any guitar? Does anybody need any guitarists? Is anybody starting a band? Da, da, da. And you will eventually meet the people that are interested in the same things that you are. That's the same thing with entrepreneurship or venture capital or angel investing, is you go to the events where other VCs hang out and you meet up with them. So ask lots of questions, yeah.
Great. And thanks for the clarification there. Now, as you think about the, investment, so if we go and we, spent a bit of time looking at Tacoma Venture Fund, and what, the fact that you're the director of investment there. So that will typically mean that you will be making decisions on businesses to invest in. Now, within the founders and mentors community, what we strongly advocate for is, idea validation, first of all. You test the idea very strongly to prove that there's a market for that idea or business in general. Now, once it's been proven strongly, whether it's pre-sales or, you're just generating a lot of buzz around it, hopefully sales, we say, is the best form of validation. Now, after that process and the business, launches and is making some headway, at what point do you think is right for a business to begin to think about raising external finance?
Well, I like to really challenge founders to really work on this process and educate themselves on how to present themselves. A lot of times they will go into a business incubator program, or they will do research online and watch YouTube videos on how to create a good presentation deck and how to, get that stuff together. There's a lot of information online available. Some founders down in the valley will go to like a Y Combinator, and then Y Combinator website has like lots of different tools. There's also local things. Ascend.vc in Washington has like little, toolkits. I think that an entrepreneur needs to really educate themselves on what they need to do in order to present their idea to investors. And at the end of the day, you're asking for money. So, okay, well, what amount of money are you looking for? And not everybody knows what amount of money you're looking for. So then my challenge to a founder is to think about what happens the day after I make the investment in you guys. What does the next year and a half look like for your company? Like, what will you do the day after? Obviously, it will be like pay yourself. So how much are you going to pay yourself? Do you have a co-founder? How much are you going to pay them? And so, that's kind of like a bottoms up approach to that. And usually it's like, if it's like one or two co-founders, you probably are looking to raise $500,000 because it's your salary for about 18 months. That could be $200,000. And maybe you have a co-founder for a year and that will be $100,000. And then maybe another one, that's $100,000. So 200 plus 100,000 plus 100,000. And then whatever business expenses you're going to have, your software, your offices, your product, your sales, yada, yada, for about a year. That is about another $100,000. Just broadly speaking, but maybe it's double that because maybe it's an expensive product. You kind of have to come out of pocket. It's all reliant about what that entrepreneur's business looks like after we make the investment, because I can get the pitch for what you want to do. So, but if I like it, I'm going to make the investment. So I need to know what the next year and a half of our journey is going to look like. And so when you come up with that sort of budget for that becomes like sort of your ask. And then what your ask really has to do is it has to align with the capabilities of your investor. If someone asks me for $50 million, okay, I don't have $50 million. So that's probably not the right ask for us. And if someone is looking for $10,000, again, that's a little small for the type of check the TVF does. So we have to get alignment between what TVF does and what the founder needs. And I can only invest based upon what the founder is looking for and what the founder is needs. So that needs to be part of the presentation process or the pitch process, is understanding what do you guys need in order to get big. And then the other thing is we need to think about what I need. A founder needs to actually match their wants with my needs. Dennis or TVF needs to provide an outsized return for my limited partners, or else I don't have a job. So when I'm investing in the company, yes, I want you to have success. I want your business to get off the ground. I want your business to be funded. I want your business to grow. I want you to get your product in the marketplace. That is true. That is true. However, I have a fiduciary responsibility to try to make an investment in a company that can deliver outsized returns for my limited partners. How does that happen? I have a kind of a very rough answer for that. We are looking for companies that can get to $10 million in yearly sales within the next 5 to 7 years. That is simple. And so my challenge to an entrepreneur when they're pitching us is, can you guys get to $10 million in yearly sales in the next 5 to 7 years? Because if you can, we will be able to find a buyer for that company. And then the only way that I can make money at TVF is to generate an exit for the companies I make an investment in. So, if a company cannot really find a way to get to that exit, then it's not investable for us. So, although I want the founder to be successful, we have to fit in those parameters that is necessary for TVF to make an investment.
Fantastic. And I think what you've said there that stands out quite strongly for me is the strategic fit there. Because, yeah, so if we use TVF, Tacoma Venture Fund as a case study, one of the key things, TVF is looking at is to sell the business at some point, hopefully to a bigger company or, whoever is willing, so that they can recoup their investment back. And now, so that means if I am a founder and I come over to TVF, I've met the criteria. Yes, I'm able to generate 10 million in sales annually in the next 5 to 7 years. I am axing my axe is within the remit or affordability of TVF. But then I think, no, I'm not keen on selling my business. I want to say grow. Maybe I want to make it a multi-generational family business. And so we get to that point of the crossroads. What then happens? Do we look for somebody else, or is there a way to get around it? I think the question here is, when you're looking for a venture capitalist firm to invest in your business, does it need to be, doesn't need to fit perfectly, tick all the boxes, or is there always room for negotiations? Like when I say, oh, I don't want to sell, how does that look like?
There is no room for negotiation as far as me trying to get a return from my investors. First of all, and then we understand that when we make an investment, many of the companies we make investments in are not going to have that result, but at least we have to try. And there are different ways. I don't want to get too technical in the documentation, but we invest using different instruments that are kind of standard. We will use convertible notes, which is debt. I mean, you can pay it off. You can pay us our debt back. There's an interest rate. There's a valuation cap tied to it. There's a very different mechanism. There are various mechanisms towards that. There are also ways. There are secondary marketplaces. There are private equity firms. There are buyouts of interest. It's okay. We can figure that out, but we need to at least get the general philosophy of, I'm looking to build a business and I'm looking to build a huge business with this, because that's what we need to do. I might have 7 companies in my portfolio right now that are failing, but it's those 3 that I'm looking for that I'm hoping to get really big on them. So, I saw 340 companies last year. We made 17 investments. We made 8 initial investments and we made 9 follow-on investments from previous companies there. So out of that 340, what is that? 5% that got, any money from us? And a lot of firms did less than us. We've only made 3 investments this year, and I've seen just about that many. So it is a really tightening funnel that we get to before we actually make the investment in a company.
Good. Thanks for that clarification. Just before we carry on, just so that we know this is a fireside chat, we do have, we welcome questions from the audience. So if you have any questions, please feel free to pop them in the chat, and myself or Dennis will be happy to address those questions. Also, we usually have giveaways. So we have giveaways to those in the States. So the William Factory Small Business Incubator sponsors a giveaway of snacks and goodies from the fully charged allergy-friendly snacks. So that's $4 to $6 worth of snacks from that company. It's a Tacoma-based business. So if you are based in the States, please, just put your name in the chat, because we would have a spinner towards the end for those in the States, and then would have a general spinner for everyone, where we give two £30 Amazon vouchers out. So Dennis, as we carry on with this conversation now, if we go back to some of the statistics you've given, you sort of reviewed 340 business plans, went through them, and then out of that, 17 investments have been made. Now, do you just want to walk us through, for some of us, I'll include myself as well, trying to, start a business and get to that stage, hopefully where we begin to seek external finance. Just walk us through your process of scrutiny. How do you, say this stays, this doesn't stay? How does that work for TVF?
Well, we're always looking for alignment between, sort of our mission and then what we need. I think I highlighted a few of them. Trust me, I can talk for 8 hours on venture capital, but we only do have an hour. So, if you need to cut me off, just cut me off. But basically, obviously I need to see the idea, and it needs to be in a digestible format. People will reach out to me on LinkedIn. People will reach out to me via email. We have a link on our website. I'll meet with any entrepreneur, especially those in our area. That's the service that I'm willing to provide. I do think that an entrepreneur should try to determine whether or not I'm a good fit for what they are looking to create. Because my job is to spend that time, if it's a half-hour call, to determine whether or not there is alignment, there is a fit. And just globally speaking, I want everybody to be successful. I have all the admiration in the world for someone that gets an idea in their head, puts it together, thinks of it, dreams about it, and wants to put that into the world. I do. And that's why I want to have, I would like to meet with them. The thing that I would ask the entrepreneur to just, self-edit once they understand what TVF does is to determine whether or not what they are building fits our investment criteria. And I already sort of laid it out. So those are the things that, and so when I see a founder, I'm looking for, is this an investable deal? Are they raising a dollar amount that fits within our, capabilities? Yesterday, I was looking at a company that was raising a convertible note at a $750 million valuation cap. And I said to myself, great. Hey guys, just FYI, there is no way I can make an investment in this company because I need this thing to become a 10x return for us. And how are you guys going to get to $7.5 billion valuation based upon what you guys are doing? And oh, by the way, you guys are raising $50 million. Like, it's just not what we do. Typically, though, I will invest in a company that is raising between $500,000 and $1.5 million. And that capital will take them about 18 months. So if you think about it, calendar-wise, I write the check today. It goes into your bank on September 1st. We have September, October, November, December, 3 months or something like that this year, 12 months next year. That's 15 months plus 3 months. That takes you all the way until April or March 2024. TVF typically writes a check for $300,000. So if you need $1.5 million, you need to be raising money from some other people, not just us. So, we're typically looking for a company that can really understand what they are doing. They have a solid plan for what they're going for. Their ask is within range of what we do. Sometimes we will invest in like a company that is only raising like $500,000, but we really have to, kind of know that space and be comfortable with it. And there are various different things like within that, maybe 500K, 600K, 700K, that we will, push and pull on and have a conversation about. But at the end of the day, like I need to spend that 30 minutes in the introductory call to figure out whether or not they fit our criteria for making it an investment. And then it's about the founder. Do I want to work with this founder for the next 18 months? And by the way, I love everybody. I'm an okay, nice person. But it's like, do I want to, go into almost like war battle, the trenches, good days, bad days, successes and failures with a person for the next 18 months? Because you are going to hate me if I make an investment in you sometimes. I guarantee it. But, we'll also love each other like a family member as well. But that's the thing with TVF is like, we're not in it to just like give money away. We are in it to have success and to invest in founders that are trying to overcome insurmountable, seemingly insurmountable obstacles. So, we have to help them along the way, and we have to hold them accountable. We have to have them, I haven't even gotten into what we actually do after we make the investment, but like, we really have to do that work. And if a founder is not willing to deal with the, sometimes they call it, the suck of something, then, we really can't work together because it's not easy. It is, blood, sweat, and tears 24 hours a day. And that's the journey we are on for the next 18 months. But luckily, when we make the investment, I become, your biggest advocate, your biggest fan, your biggest, kind of partner. After that, maybe you don't want me to be your partner. I don't know. Who knows? So, yeah.
Fantastic. Thank you very much, Dennis, there for very honestly telling us how it works at TVF. And it'll be similar across other venture capital firms as well. Because one key thing I think a lot of people have to understand is the money that you're giving out to these entrepreneurs, these startups, and money that you've taken from your investors as well, your limited partners as well. And there has to be some form of returns being generated. So it does make sense that, high levels of due diligence are undertaken. And, I do know that in the media, in academic literature, it is highlighted that, people have to be wary when they take on money from VCs, because sometimes the pressures from VCs make people, make these startup founders begin to do things that they, or sort of maybe engage in strategies that they ordinarily or initially did not want to engage in. I remember, so there's one of the top business schools here in London, the London Business School, and last year they did have their private capital symposium, which sort of attracts key venture capitalist firms from across Europe. And one of the key things they highlighted then is, VCs have to be aware of the pressures that they put on startups and things like that. And they did mention or sort of refer to Theranos, the Theranos case, where I don't know if you've seen Dropout. Dropout is a series on Disney where they it was just, telling the story of Theranos, Elizabeth Holmes, and how she sort of took the company, did things that she wasn't supposed to do because she needed to provide returns for her investors. Now, and I think that has to be a fine balance. It's very difficult to draw a thin line, is it, to find that balance between giving people some room and sort of telling them, things need to move on and things need to be done. We need to see results. So, however, you draw that fine line, but, these things have to be done. We need results. We've given you money, we need results. Sometimes people might not, and I think it's what I think for founders to spend a bit of time speaking to people that have, taking money from VCs or work with VCs to understand the process better and see if it's something that they're ready for, so that you don't, because most times I'm always an advocate for trying as much as possible to maintain amicable relationships. Just like you said, you're keen to maintain good relationship, but sometimes some people, they're not aware of, or they're not really aware of what the process is like and what is required of them. So yeah, it's always good to speak to people who have gone through the process and, just make sure it's something that you want. But I have a question here, and this is from Garrett. Garrett says, has TVF done any gaming deals?
Like poker? Video games?
Yeah, video
games.
games. Yeah.
We've looked at companies in that space. I haven't made any investments. All of our investments are available on the TVF website. We are sector agnostic, so we would take a look at things. I mean, what I would just say to an entrepreneur that is doing something that, is in a niche industry that, there are certain types of investors that really specialize in that. Think of TVF as being like a syndicate partner with true experts in that space. So I'm not going to tell anybody that I am a true expert in one space or another. I might be a true expert in, like, rock and roll music of the 1990s or something like that. But I wouldn't say that I'm a true expert in video games. But there are investors that are. So, you want to think about, like, okay, and think about your journey to getting investor capital as like pieces of the puzzle, or a pie. Maybe you own 50% of a pie, and there is an empty 50% of that pie. And what your job is to put little pieces into that pie to make it 100%. And so TVF would be one little piece of that pie. And what do we provide? We provide, capital, we provide investor knowledge. And then you would have another piece, and then it's like expertise with the product. Tim put in there how important are role models and mentors. What I think about it is team. We have our internal team and we have our team of advisors and investors. Some investors are just cash. Other investors are cash and process. Other investors are expertise. Maybe you're not looking for money from them, but they are the GOAT in that industry. So you want them on your team, and we want them on your team. So that's where I think about that is like, when there is a sort of a niche industry, fashion, who on your team really understands fashion? We're thinking about making an investment in an area in the golf industry. I don't know much about golf. I'm watching golf on TV all weekend, trying to figure out what I know about it. I don't know anything about golf, but there's something I like about the company. So, and then we find out that there's other experts and investors that are in the deal. So then I don't have to know everything about golf. All I have to do is talk to this other investor, and they can kind of fill in the gaps that I don't have. So think of your fundraising journey as like, yes, you might want some money from TVF, but you also want to get absolute expertise. And I related to VC firms that are really successful. One of the ones in our area in Seattle is Madrona Venture Partners. And when you do a deal with Madrona, the 5 or 6 key people in that company are all absolute experts in their field, professionals, all stars in their industry. They don't make a guess at like, oh, maybe this person will work for marketing. Oh, maybe this person will be good for finance. Nope. Every single person is an accountable professional that has done it before in their industry, because it is so hard to build a company nowadays that you can't afford to not have experts. And you have to have experts in the internal team. You have to have experts in your advisor cohort, your investor cohort, whatever. And then, TVF is just one little piece of that. So, and that's why that's what we have to do in order to try to get successful here, is who else is in it with us. It's, it's like we're a team. Sorry, I went too long to answer that question, but
no, then that's fine. That's fine. I think what really interests me there is the syndicate approach that you say you take on there, willing to co-invest with other VC firms that are investing in a business. Now, from that perspective as well, it's a case of, when you're say you're taking a syndicate approach, when you're co-investing with other investors into a certain deal, what do you look out for in terms of the relationship between TVF and co-investors? What are you in terms of maybe value and some of the fit? What else are you keen on when you're to make sure that we will all be good co-investors in this deal?
Well, I mean, I think that most of the people that have experience in the field are fine to work with. Sometimes they have bad intentions or influences, and you just have to kind of figure that out and work within them. But at the end of the day, we're all in it for the same goal, is to build a big company. So one thing that I guess I haven't really talked about is, after we make an investment, if we are the leader of the deal, we usually will create an after investment relationship with the founder. And that is a monthly check-in call. It's usually about a half hour. Sometimes it's 15 minutes. Sometimes it's only quarterly if the company is already really up and running and busy and big and that kind of thing. But we're usually doing a regular check-in, and we hold it to a calendar, and we hold the founder accountable to that. If you don't want to do it, don't take our money. Get it from somebody else. But we do this. This is part of our playbook. We are usually going off of a strategy of OKRs. And if you want to do some reading on it, there's a book called Measure What Matters by John Doerr. It's a very kind of common, VC founder relationship book. And the idea is, you create, at the beginning of a period, you create objectives. And KRs are the key results that feed into that objectives. And you can put it throughout the whole entire enterprise, and every division can have OKRs, and every employee can have OKRs. And you can have your kids, when they go to school, what is your objective? To get all A's. What are the key results? To get A's on my classes. You know what I mean? OKR for athletics. What do you want to do? I want to win the championship. It's a way to kind of like go through the world with goals and do that. And so what we try to understand then, after we have the objectives and the key results, is what are the key ones for this company. It's usually a conversation between us and the founder, and we are just doing what the founder needs to measure what matters for success. And we usually do like 5 or 6. Anything more is a little bit too in the weeds. We just want to see the 36,000 foot, situation on that company. One of the OKRs could be sales. What are your sales? And then you track that throughout the year on a monthly basis. What are your monthly sales? Our monthly sales this month are $1,000. What are our objectives? Our objectives is to add $1,000 in sales every single month. So in January, it's 1,000, February, it's 2,000, March, 2,000, 3,000, whatever it is, boom, 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 boom. So by the time we get to the end of the time horizon, the goal might be like, oh, we're hoping to get to $30,000 per month throughout, the calendar year of 2024. for example. Oh, okay, great. And then what are some other key results that you want? We want to add one customer a month paying $1,000. Good. So how many customers do you have? 1, 2, 4, 5, 10, da da da, like all the way through. And then we measure what is like how we are performing against those. What you say in January will definitely not exist what you say in December. So how are we against that? Well, we thought we were going to do $1,000 per month, but instead we're actually doing $2,000 a month. Good. So we realize it's working now, or it's like, oh, this is not going well at all. We are having a difficult time getting product market fit, and we are way below. We've only got to $500 per month, and we are 9 months into this process. Okay, great. Well, we need to adjust that because I think we're doing that. And then so it's like you get your revenues, maybe you have your customers, maybe you have your monthly expenses. We would like to set our monthly expenses at $50,000 a month. Okay, great. Then it is cash burn. How much money are we losing per month? Well, we have expenses of $50,000 per month, and we have sales of $1,000 a month. So our cash burn is $49,000 per month. Okay, great. How much money do we have in the bank? We have $490,000 in the bank. Okay, great. So we are burning $49,000 per month, and we think we're going to burn about $49,000 per month for the next year, and we only have $490,000 in the bank. So we have 10 months worth of runway. And then where are we going to be in that 10 months? Where are our sales going to be? Where are our customers going to be? Where are our expenses going to be? What is our cash in the bank going to be? Because when we are at zero money in the bank, we need to know where we are as a company. And that exercise informs the decision-making process of that. I know that we're in September right now, 4 more months, 6 months. So we know that this company is out of business in June, or they are out of money in June. So what are we going to do? Are we going to be profitable by June? Or are we going to have to raise more money in June? Are you going to raise it from TVF in June? Or are you going to raise it from other people? Are you having those conversations now? Do you know who you want to raise your next money from? So we go through these methodical exercises after we make the investment, or we talk about it before we make the investment, and we go through these exercises after the investment. So I know, and I have 22 portfolio companies. I know where all of my 22 portfolio companies are measuring themselves against their OKRs. If you name any company in my portfolio, I'd be able to be like, yeah, Flavorcloud. Okay, great. So this is what they're doing in their monthly sales. This is when they think that this is what their cash burn is. And this is where they expect to get profitable. And this is when they need to raise more money. And if I'm talking to the founder,
I'd have asked you about Joe. I think the Joe, so I've gone to your website, I've looked at the portfolio. So if I ask you about Joe, what's the summary in terms of their financials and how they're doing?
That's a little private.
Okay. It's fine. It's fine if it's private. It's fine if it's private.
No, it's okay. It's okay. Joe Coffee is a platform that is almost like the Starbucks app platform, but independent coffee shops. And I am a board observer on that company. They get paid every single time someone places an order in one of their participating coffee shops, and they get like a take off of that. And then the more people do that, the more they sign up, they do well. They are a company that is driving towards profitability, and they are very, very aware of what their burn rate is. So, and I talk to the founder probably every month or so, and then I am on their board of directors calls every month as an observer. And a really good board of directors call, by the way, this is probably, we only have 3 more minutes. You want to prepare your investors for a board of directors call in advance. There are different websites to go to on how to do that. And so the founders of that company send us their slides like 6 days in advance. Here is what we're doing operationally. Here are KPIs. Here are objectives over the next couple of months. This is what we're looking to try to do as far as fundraising is concerned. This is some open discussion that we have to have with the board of directors. And I, as an observer, sometimes drop off the call because I'm not on the board. I can't really vote. And so, there are things that I hear, and there are things that only the board members hear. So yeah, I mean, Joe's doing very well. They're great founders. They're very professional, and lots of success coming their way.
Good. Thanks for that. Just for the sake of time, we normally do our spinners. So it's just me today. One of the wonderful ladies that help us wasn't able to come on. So what I'm going to do is I'm going to just quickly share my screen. It doesn't really take long. I've set it up already. We have
Winifred, can I interrupt by saying, Derek, the answer is it's really important.
Yeah, that's fine. That's fine. Dennis, do you want to answer?
Answer.
You said you wanted to answer Derek.
I did. I answered it.
Okay, that's cool. All right, so we're going to just quickly, we're starting off with the Amazon vouchers, and I'm going to spin this, and then we will see who wins. So this is the first one. So Walter, I will contact you. So Walter has won the first Amazon voucher. We'll do the second one. So Angela, I'll be in touch. I've got your email address. I'll be in touch. So Angela has won the second Amazon voucher. So we're going to move on to the next. This is for the Americans. We do give away $46 worth of goodies from the fully charged allergy-friendly snacks company. So click on here to see who's winning. Yeah, so that's Garrett. Tim would be in touch, and he will sort of get your address and send you over those snacks. So now we're at the end. It's 7:30 on the dot. So thank you very much, Dennis, for your time. Just before we go, do you want to leave us with any closing remarks, Dennis?
Well, actually, one thing that I would do a plug for is a really good podcast that could be fun for people to check out. It's called the Founders Podcast. It's meant to be just like a little bit of a light podcast, and it's very good because it talks for those of us that are entrepreneurs. It talks about the mindset of successful entrepreneurs as a result of the host of the podcast reading their biographies. And I don't know, I like it. What the first one I would recommend is listening to Estee Lauder's the woman Estee Lauder, not the brand. Her biography is wonderful. And it shows, the grit and passion, her starting her business when she was 40 years old. And running it for 50 years. I related to that because I started TVF when I was 44 years old, and I hope I have this dream of kind of being on stage like Warren Buffett when I'm celebrating TVF's 50th anniversary. That kind of dream allows me to think of building TVF over the long term. And realizing that even though I might have started late in life, there is still a long kind of journey for us to build our companies. And it allows me to be patient over these tiny little moments of success or failure, and just realize it's like we're in this thing for the long term. And I hope TVF outlives me.
Fantastic. That's a very wonderful and inspiring closing remark there. Dennis, I've sort of put that down, the Founders Podcast, as well as the book, Measure What Matters. Those two I would certainly go and have a look at. But thank you very much. I do agree with that philosophy. That's the key philosophy of Melody Hobson's RL Investment that she's the co-CEO of. Slow and steady wins the race. So I do appreciate that a lot. But thank you very much, Dennis, for sharing your expertise and your time. We've overrun by a few minutes, But I hope that's been okay for everyone. I hope everyone did enjoy our call and discussion today. This is recorded and we'll be sharing out the recording once it's ready. Thank you again, Dennis, and thanks to everyone that attended today. Bye, everyone.
Bye.
Bye. Good.